Australian property prices are at record highs. After massive growth over recent years, with prices jumping more than 50% in just 5 years, many Australians are wondering the same thing. Is a crash coming? Let me give you the straight answer up front. Based on all the data we have right now, a big property crash in Australia over the next 5 years looks very unlikely. But that doesn't mean everything will be perfect. The truth is more complicated, and understanding what's really happening could help you make better decisions about buying, selling, or investing. To answer this properly, we need to look at what's happening right now, what the experts think will happen, and most importantly, the basic forces that will push prices up or down through 2030. What's happening right now? Australian property prices have hit record levels in most cities. As of September 2025, the typical Australian home costs $844,197. That's up 3.7% in the past year, and an amazing 50.4% over 5 years. Sydney is still the most expensive, at $1.23 million for a typical home. Brisbane comes next, at $935,000. Actually, Brisbane just overtook Melbourne to become the second most expensive city. Melbourne now sits at $803,000, after struggling a bit in recent years. Perth, Adelaide, and Brisbane have been the big winners lately. Perth prices jumped 6.5% in a year, Adelaide by 7%, and Brisbane by 7.3%. These smaller cities have done well because people have been moving there from Sydney and Melbourne, and they're still more affordable. Here's what's really interesting. Prices are going up, even though interest rates were very high until recently. The Reserve Bank raised rates 13 times between May 2022 and late 2023, taking them from basically 0 to 4.35%. Most people thought this would crash the market. It didn't. After a small dip in late 2022 and early 2023, prices started climbing again. Since February 2025, the Reserve Bank has cut rates 3 times, bringing them down to 3.6%. These cuts have given the market a big boost, with September 2025 seeing the strongest price jumps since late 2023. What the experts think will happen. When we look at what the big banks and property research companies think, they all pretty much agree prices will keep going up, not crash. Domain predicts Sydney house prices will jump another 7% to reach $1.83 million by June 2026. That's an extra $112,000 in just 1 year. Melbourne should go up 6% to $1.1 million, Brisbane by 5% to around $1.09 million, and Adelaide by 4% to $1.05 million. For apartments, it's similar. Sydney apartments should climb 6% to $889,000, while Brisbane units could hit $701,000, up 5%. The 4 big banks all say prices will keep rising. Westpac thinks 3% growth this year and 7% next year. NAB predicts 3.3%, then 5.6%. ANZ expects 5%, then 5.8%. CBA says 6% this year and 4% next year. SQM Research is even more positive, predicting growth between 6 and 10% over the next couple of years. Looking ahead to 2030, if recent growth patterns continue, the numbers get really big. Sydney's typical house could reach $2.4 million by 2030, up 61%. Brisbane might hit $1.53 million, a 68% jump. Adelaide could reach $1.47 million, up 75%. Now, these aren't guaranteed. PropTrack calls them a thought exercise, showing what might happen if things keep going the way they have been. But they show how strong the forces pushing prices up really are. Not one major bank or research company is predicting a crash. The worst-case scenarios they mention involve small price drops in already expensive cities like Sydney and Melbourne, not anything like a real crash. What makes property markets crash? Before we go further, let's understand what actually makes property markets crash. Crashes don't just happen randomly. They need specific things to go wrong, usually several at once. Looking at past property crashes in Australia and around the world, they usually involve too many houses being built, lots of people losing their jobs, people being forced to sell quickly, banks stopping lending, and panic spreading through the market. The United States housing crash in 2008 is the perfect example. Banks were giving huge loans to people who couldn't afford them. Way too many houses were being built. Then the whole lending system froze up. When prices started falling, everyone panicked and tried to sell at once, making everything worse. Ireland's property crash was similar. Prices fell more than 50%. This came after years of building way too many houses, lots of risky buying, and the whole economy collapsing. Australia's property market has had some tough times before. In the early 1990s recession, and during 2017 to 2019 when banks got much stricter about lending, prices fell of 10 to 15%, but these were drops, not crashes of 30 to 50%. The big question is, do we have the things that could cause a crash in the next 5 years? Not enough houses being built. The single biggest reason Australia won't have a property crash is simple. We don't have enough houses. And it's getting worse. Australia needs to build between 240,000 and 280,000 new homes every year just to keep up with how fast our population is growing. We're way behind. In 2024, only 163,760 new homes got approved to be built. That's about 70,000 fewer than we need. Building approvals actually dropped 6% in August 2025, after falling 8.2% in July. Apartment approvals are 25% lower than they were between 2017 and 2021. The building industry is struggling with not enough workers, expensive materials, and difficulty getting money to build. Many builders simply can't make money building at today's prices. The government set a big goal to build 1.2 million homes by mid-2029. The Property Council of Australia says we'll probably fall 462,000 homes short. Even optimistic guesses suggest we might only build 191,000 homes per year. Meanwhile, more and more people want houses. Australia's population grew by 660,000 people in 2024, mostly from immigration. While fewer people are moving here than in 2023, it's still a lot at 446,000 for the year ending June 2024. Australia has about 27.6 million people now. By 2030, we'll have over 30 million. By 2060, we'll have 40 million. That's nearly 3 million extra people needing somewhere to live in just the next 5 years. You can really see this problem in the rental market. Only 1.5% of rental properties are empty across the country. That's about half what it normally was between 2015 and 2019, which was 3.3%. In Darwin, empty rentals have dropped 53% below normal levels. When rentals are hard to find, it helps keep property prices high in two ways. First, people buying investment properties can charge good rent, which makes buying properties attractive. Second, people who can't find rentals to rent often decide to buy instead if they can, which means more people trying to buy. This basic math of not enough houses for too many people is the main thing stopping a crash. Even if other things go wrong, this shortage keeps a floor under prices. What about interest rates? Many people think rising interest rates could crash the market. The thinking goes like this. If rates go way up, people can't pay their mortgages, they have to sell, and prices collapse. But what happened recently in Australia doesn't fit this story. Even after 13 rate rises in a row, prices only fell a little bit before going back up. Why? First, most Australian homeowners were in pretty good shape when rates started rising. Years of very low rates meant many people built up good savings and paid extra on their mortgages. Reserve Bank data shows less than 1% of people owe more than their house is worth. Most mortgage holders owe well under 80% of what their house is worth, with many owing only 40 to 60%. And get this, half of all Australian homeowners have paid off their mortgage completely. This means even if times get tough and some people struggle, most can handle it without losing their house. They can use their savings, or in the worst case, sell their house and still have money left over. Second, when banks give out mortgages now, they check if you could still pay at rates about 3% higher than what you're actually paying. This safety buffer means most borrowers can handle rate increases without getting into trouble. Third, Australia's job market is very strong. Unemployment is near record lows at around 4%. Having a job is the most important thing for paying your mortgage. Looking forward, rates are actually going down now, which helps borrowers. The Reserve Bank has already cut rates 3 times in 2025, and most experts think at least one more cut is coming, maybe 2 or 3 by mid-2026. Some experts, like NAB's chief economist, think the cash rate could fall to 2.6% by early 2026. Lower rates mean people can borrow more and feel more confident about buying. History shows that when the Reserve Bank starts cutting rates, property prices usually go up. Bank of Queensland looked at 40 years of data and found that a 10 to 15% price jump over 2 years is normal when rates start falling. But here's an important point. The super high jumps of 20% plus that happened in the 1980s, 2000s, and during COVID probably won't happen again. Back then, unemployment was much higher or other special things were happening. Right now, unemployment is very low, which is good for the economy, but means the price jumps probably won't be as extreme. People's jobs and money matter more than almost anything else for property prices. If lots of people lose their jobs, that's when crashes happen. If people keep their jobs and earn more, they can keep paying mortgages and even buy houses. Right now, things look pretty good. Unemployment is around 4%, which is very low by historical standards. Before the 1990s recession, unemployment was over 10%. During the global financial crisis, it went above 6%. Today's 4% means almost everyone who wants a job can get one. Wages are also going up faster than inflation now. Real wages have grown to their highest level in 5 years. This means people's money actually goes further than it did before, even with all the cost of living increases we've seen. The government predicts unemployment will stay below 4.5% for at least the next couple of years. Unless something really unexpected happens in the global economy, mass unemployment looks very unlikely. There's also something called the wealth effect. When people see their house is worth more and they have a job, they feel more confident. This confidence makes them more likely to spend money, move house, or buy investment properties. As prices go up, this creates a positive cycle of confidence and activity. Who's buying properties? One big change in the property market is who's actually buying. It's not just regular families with mortgages anymore. About 1/3 of all properties sold last year had no mortgage at all. These are people buying with cash. Often they're older people downsizing from a big family home, or they're wealthy buyers using money they already have. The bank of mom and dad is also playing a huge role. Parents and grandparents are helping young people get deposits together, or inheriting money is helping people buy. This means even though borrowing is more expensive, there's still plenty of buying power in the market. From October 1, 2025, a new government program started that makes it easier for first home buyers. Now they can buy with just a 5% deposit without paying extra insurance, with the government backing the rest. There's no income limit and unlimited places in the program. This will bring even more buyers into the market, especially at the cheaper end. Then there's what people call rent-vestors. These are people who rent where they want to live, but buy investment properties somewhere more affordable. They're keeping investor demand strong, even in the current market. All these different types of buyers mean demand stays high, even when traditional borrowers might be struggling with higher rates. Regional differences matter. Not every part of Australia will do the same thing. There will be big differences between cities and even between suburbs in the same city. Sydney and Melbourne usually lead when rates are cut because they respond fastest to changes in borrowing costs. After being a bit weak, they're picking up now. Melbourne has been particularly slow, which might actually make it a good opportunity if you're thinking long term. Brisbane, Perth, and Adelaide have been the stars recently. But when markets run really hot really fast, you have to be careful. Some experts worry that Perth, especially, might have grown too fast, particularly in cheaper suburbs where lots of investors from Sydney and Melbourne have been buying. When that investor demand slows down, those areas might struggle. Brisbane has the Olympics coming in 2032, which is driving lots of building and investment. Queensland's population is expected to grow by 500,000 people in the Brisbane area by 2046. That's a lot of people needing houses. Regional areas had a huge boom during COVID when people wanted to escape the cities. But over the long run, capital cities have always done better than regional areas. Regional areas are now nearly as expensive as cities in many cases, which takes away their main advantage of being affordable. Once that's gone, why would you choose regional over a capital city if prices are similar? Within cities, the gap between good suburbs and struggling suburbs is getting bigger. Areas with good infrastructure, close to jobs, with good schools and transport are pulling away from areas without these things. The key is that gentrifying suburbs in inner and middle rings of big cities are likely to do best. These are areas where wealthier people are moving in, upgrading houses, and the whole neighborhood is improving. These areas benefit from being close to everything people want while still being more affordable than the very best suburbs. The rental market is super tight right now, and this is a huge support for property prices. National rental vacancy rates are just 1.5%. That's ridiculously low. Between 2015 and 2019, it was normally 3.3%. Darwin's rental vacancies have dropped 53% below normal. When rentals are this hard to find, rents go way up. National rents jumped 0.5% just in August 2025, the fastest monthly growth since May last year. Over the full year, rents are up 4.1%. A big report by CBRE predicts apartment rents will grow 24% between 2025 and 2030 across Australian capital cities. By 2030, 92% of two-bedroom apartments will rent for more than $700 per week, and 33% will be over $1,000 per week. Sydney already has the highest rents, with houses at $833 per week and units at $749 per week. Even Hobart, the cheapest capital, has house rents at $603 per week and units at $506 per week. For property investors, high rents mean good returns. Darwin is leading with rental yields around 6.5%. When investors can get good rental income, they keep buying properties, which supports prices. The rental crisis also forces people who want to rent but can't find anything to consider buying instead if they possibly can. This moves people from the rental pool to the buyer pool, increasing demand. CBRE expects vacancy rates to fall even further to 1.1% by 2030 from 1.8% now. Over the next 10 years, they predict demand for housing will get a triple boost from more people, 4.1 million extra, more jobs, 2.8 million extra, and higher incomes, up $39,000 on average. They estimate about $960 billion of extra income in the system to pay for mortgages, rent, and living expenses. What could actually go wrong? While a crash looks unlikely, it's important to understand what could go wrong. No forecast is perfect. The biggest risk is probably something unexpected in the global economy. If there's a major global recession, it would hurt Australia too. Our economy is very connected to the world, especially to China. If China's economy has serious problems, that would affect Australia's mining exports and hurt our economy. Former U.S. President Trump's trade policies created some uncertainty. He announced big tariffs on many products, which could slow down global trade. Though he's changed his mind on some, the uncertainty itself can hurt business confidence and investment. Some economists now think central banks, including Australia's Reserve Bank, might cut interest rates even more than expected to help the economy, which actually would help property prices. Climate change and natural disasters are becoming more important. Severe floods, bushfires, and storms can make some areas less attractive to live in and harder to insure. Areas at high risk might see prices stagnate or fall, while safer areas do well. Government policy changes could affect the market. There's been talk about changing negative gearing rules or capital gains tax. If the government made big changes to these, it might scare off some investors. However, this looks unlikely in 2025, with most discussion staying as just discussion. Building costs have gone way up. Materials, labor, and financing are all more expensive. This makes it hard for developers to build new homes that people can afford. Ironically, this shortage of new homes actually supports prices for existing homes, but it makes the housing affordability crisis worse. Banking rules could change. If regulators make banks much stricter about lending, it would reduce how many people can borrow and how much. This happened in 2017 to 2019 and did cool the market down. Housing affordability is a real problem. While prices are unlikely to crash, housing affordability is a serious social and economic problem that's getting worse. The typical house in Sydney now costs $1.23 million. The typical unit costs about $800,000. For a single person earning the median income of around $70,000 per year, buying even a basic apartment is almost impossible without help. First home buyers are really struggling. You need to save for years just to get a deposit together. Many young people are giving up on ever owning a home, which is a major social shift. The new government program allowing 5% deposits might help some people get in, but it could also push prices higher by bringing more buyers into an already tight market. Treasury predicts it will only add 0.5% to prices over 6 years, but many experts think the real impact will be bigger. Some economists worry we're pricing an entire generation out of home ownership. If only people with wealthy parents or high incomes can buy, it increases inequality and changes the social fabric of the country. The government's target to build 1.2 million homes by mid-2029 is meant to help, but we're way behind. Even if building speeds up dramatically, it won't fix the problem quickly. Long-term historical perspective. It helps to look at the long-term history of Australian property prices. Over the last 30 years, house prices have grown an average of 6.4% per year. That's despite the global financial crisis, the early 1990s recession, and several other economic shocks. To put that in perspective, a house bought for the median price of $122,870 in 1991 was worth $795,208 in 2021. That's more than 6 times the original price. Property moves in cycles. There have been times when growth was much higher than 6.4% and times when it was lower or even negative. But the long-term trend has always been up. Looking forward, strong population growth should keep demand high. We're expecting to go from 27.6 million people now to 30 million by 2030 and 40 million within 4 decades. Between 240,000 and 280,000 new homes need to be built every year just to keep up. On the supply side, we're in the middle of a housing crisis that's not getting better anytime soon. The gap between what we need and what we're building is actually getting bigger. Put simply, more people wanting houses, plus not enough houses being built, equals higher prices. This basic formula has supported Australian property for decades and looks set to continue. Different markets will perform differently. The national figures hide huge differences between different types of properties and locations. Houses have done much better than apartments recently. The typical Australian house now costs $223,000, or 32.3% more than the typical apartment. This gap is at a record high. But this might actually create an opportunity. Good apartments in great locations are now available well below what it would cost to build them. For investors and first home buyers who can't afford houses, quality apartments might offer better value. The gap between the best performing suburbs and worst performing suburbs is getting wider. It's not enough to just buy property. You need to buy the right property in the right location. Strategic investors who choose well could see their properties double in value within 7 to 10 years based on the historical 7% annual growth. Properties in premium locations with infrastructure investment, good transport, employment nearby, and lifestyle amenities will likely do much better than the average. On the other hand, properties in struggling areas with limited infrastructure, poor transport, and no clear growth drivers might barely grow at all or even fall in value. The message is clear: location matters more than ever. Buying in a gentrifying inner-city suburb will give you very different results than buying in a struggling outer suburb, even if both are in the same city. What this means for different people. If you're thinking about buying your first home, waiting for a crash probably isn't a good strategy. Most experts think prices will keep rising, not falling. The longer you wait, the more expensive it gets. If you can afford to buy now, even with current rates, you'll probably be glad you did when you look back in 5 years. The new 5% deposit program starting October 2025 makes it easier to get in with less savings. But remember, even if you can buy with 5% down, you still need to be able to pay the mortgage every month. Make sure you can handle the repayments comfortably even if rates go up a bit from where they are now. If you're an existing homeowner, your property has gone up a lot in value over the past few years. You're sitting on significant equity. Whether you're thinking about upgrading, downsizing, or staying put, you're in a much better position than people trying to get into the market. For investors, the outlook is generally positive, but you need to be smart. Don't just buy any property anywhere. Focus on quality properties in strong locations. Look for areas with infrastructure investment, population growth, and strong rental demand. Be careful about jumping into markets that have already had huge growth, like Perth. Some of the cheaper suburbs there might struggle when investor demand from the eastern states slows down. The smart money would have bought there 2 to 3 years ago. Melbourne might actually be worth looking at now. It's been the weakest performer, which means it's relatively cheap compared to other capitals and might offer good value if you can hold for the long term. For renters, unfortunately, the news isn't great. Rents are likely to keep rising because there just aren't enough rental properties. Vacancy rates are so low that landlords can charge high rents and still find tenants quickly. The bottom line: so will Australian house prices crash in the next 5 years? Based on all the evidence, the answer is no. Every major bank, research institution, and property expert is forecasting continued growth, not collapse. The forecasts range from modest growth of 3 to 4% per year to stronger growth of 7 to 10%, but nobody credible is predicting a crash. The fundamental reason is simple. We have way more people wanting houses than houses being built. This shortage is getting worse, not better. Unless something dramatic changes with immigration or building activity, this imbalance will keep supporting prices. Interest rates are coming down, not going up, which helps buyers. Employment is strong. Most homeowners are in good financial shape. Investors are returning to the market. Rental demand is incredibly high. The conditions that create crashes like mass unemployment, huge oversupply, credit freezes, and panic selling just aren't present and don't look likely to develop. However, this doesn't mean it's all good news. Housing affordability is a serious problem that's making it harder for young people and low-income earners to ever own a home. The gap between rich and poor is widening. Regional inequality is growing as some areas boom while others stagnate. The market will also be fragmented. Not every property everywhere will do well. The best suburbs will keep pulling away from struggling areas. Houses will likely outperform apartments, though good apartments in great locations could offer value. If you're making decisions about property, don't wait for a crash that probably won't come. Focus on buying quality in good locations if you can. Think long term. Property is a 7 to 10-year investment minimum, not a quick flip. If you can't afford to buy now, work on building your deposit, improving your income, and positioning yourself to buy when you can, but don't hold off expecting a crash to make it easier. The Australian property market has been remarkably resilient through everything thrown at it over recent years. The fundamentals supporting it remain strong. While challenges exist and nothing is certain, the path of least resistance appears to be continued growth, not collapse. For better or worse, expensive housing looks to be Australia's reality for the foreseeable future. Understanding that and planning accordingly is more useful than hoping for a crash that's unlikely to arrive.